Welcome to Clearway Capital Solutions podcast series. I'm Dennis Mothoneos from Clearway Capital Solutions, and I'm joined by Eric Woodworth, Deputy CIO of DSM Capital Partners, a global equity specialist manager, to answer 10 plus 1 questions about DSM Capital. As some of you might know, Clearway Capital works very closely with DSM in helping them to grow and maintain their business in Australia and New Zealand. Eric, very briefly, tell us about the history of DSM Capital and what it does.
Thank you, Dennis, for hosting us. So DSM Capital's been in business for roughly 20 years. We manage about $8 billion in institutional and high net worth assets. We started a U.S. large cap strategy in 2002. We started a global focus strategy in the 2009-2010 timeframe, and then also culminated with an international strategy around 2015. The two partners who founded the firm, Dan Strickberger and Steve Mamishian, took their prior experiences and wanted a firm that was focused on deep fundamental research while having a valuation discipline as well. And I'm sure we'll discuss that a bit further on. We're focused on high quality growth companies. To us, high quality means predictable and sustainable growth, because as earnings compound over time, a stock price over the medium to long term has to reflect that earnings base and that earnings growth. Like I mentioned, we have a valuation discipline that we hope controls for risk. We're a concentrated manager, so we're not a benchmark hugger with 75, 100, 150 names in our portfolios. We typically have 30 to 35 names in our strategies. Myself, along with colleagues, we're generalists, so we get to go anywhere by geography or industry to try and find the best growth companies at a reasonable valuation. We have a long tenure of the team. The majority of the investment team has been together for at least 15 years now. I was actually the first analyst that Dan and Steve hired back in 2001. 4 or 5 of us have been around since the beginning of the firm. So that's a little bit about DSM Capital Partners.
You've already covered some of the points of difference, but maybe you can expand on that, Eric. What are the points of difference between DSM and other global equity managers?
Sure. I think one is the concentration, like I mentioned, having 30, 32, 33 names in the portfolio. We're very discerning about the type of names that we put into the client portfolios. We have to say no a lot more than we say yes. And as companies continue to deliver and our conviction grows, we will build up those positions to 4, 5, 6% position size. So we are concentrated. I think the one key aspect about DSM that I think separates us from a lot of growth managers is the valuation discipline. So we typically do not invest in the very high growth, high valuation stocks like Tesla, Sea Limited, Adyen, etc. We just think that paying 100, 200 times earnings, 15, 20 times sales is quite risky. When those companies have a bit of a hiccup or stumble on an earnings report, law of large numbers start to come into the equation, those stocks can be down 20, 25, 30% on those earnings reports when they disappoint. And that, for us, is just too much risk to take on. We think we can generate good, solid, long-term returns by investing in high-quality growth companies, but at a reasonable valuation. So I think that's a key aspect that investors should know about DSM. And that's actually serving us quite well in this environment where we've seen a very dramatic sell-off in the higher valuation, more speculative type of stocks. Our PE of the portfolio trades at about 18, 19 times. So we're fairly well insulated from that downdraft in the higher PE stocks. I guess one last thing to mention is we have colleagues from China, Japan, and India. so good geographic coverage with the team.
Eric, how important is culture at DSM?
Culture is very important. Like I mentioned, the majority of the team has been working together for 15 years or more. So there's a lot of institutional knowledge built up. We've had multiple people look at the same name. And so when you get into a discussion about a particular stock or geographic region, you have many people that can offer an opinion, some insights, some experience with a particular stock. For example, if somebody's out on vacation or out on the road at a meeting and something comes up on a particular name, there are people back at the office that can react to that. We all know the type of stocks that we're looking for, so we can easily pick through or go through searches and say, yes, that's a DSM type of stock. Let's spend some time there. Or no, that's not a DSM type of stock. Let's not waste our time there. Everybody's on the same page in terms of the type of companies we're looking for, and combined with the valuation discipline. So culture is very important at DSM. I think it says a lot that a number of us have been there for a very long time. It's a very collegial place. Everybody's opinions are respected. And I think that just says a lot about the culture at DSM Capital.
Is it becoming more difficult to deliver alpha in the asset class?
It's a good question. I think if you buy high quality companies at a reasonable valuation, you can still deliver alpha just like we have in the past. Our valuation discipline has hurt us a little bit the last 6 or 7 years with super low inflation and interest rates, but we think that could help us in the new market environment of rising inflation and rising rates over the next 2 to 3, 4 years. I think what you saw over the last 5, 6 years is a lot of crowding into those high growth stocks. A lot of people were chasing the same names. There's a lot of speculation in unprofitable companies, crypto and Bitcoin, NFTs probably being the ultimate example of that speculation. And, when interest rates are zero or even negative, you have government stimulus and a lot of quantitative easing by the central banks. It creates a speculative environment. But I think that is changing now. And as long as you adhere to a discipline of the high quality growth companies and you haven't overpaid to begin with, you can still generate significant alpha over time.
What can quality growth equities contribute to a multi-asset portfolio?
Sure. If you don't overpay to begin with or stay too long when valuation gets very unreasonable, high quality growth companies can help defend in a volatile macro and geopolitical environment and thus add value. As long as the earnings growth is coming in largely as expected, over time, that compounding will drive a stock higher. And while a stock may lag for a quarter or two, or maybe even a year, as long as the earnings are coming in as expected over the medium to longer term, a stock has to reflect that earnings value.
What are the largest risks across the portfolios? What typically keeps you up at night?
Yeah, good question. I think what we're seeing after 2 years of COVID lockdowns and restrictions, is now economies are opening up or fully opened up, and we're seeing a reversion to consumers wanting to buy experiences, go travel, go out to eat, and they're not purchasing as many goods anymore like they were when they were locked down at home. So there are some concerns over companies like PayPal, Amazon, online advertising as we revert to more spending on travel and experiences versus goods. Does that cause a significant slowdown in some of these names? Second issue we're watching is supply chain. We read about it every day about, certain companies can't get raw materials, their freight costs are going up, they can't source certain things, plants are locked down or shut down. And so any entity that makes and ships product is going to be impacted in some way. And so that has caused us to trim or sell certain names that we thought were overly exposed to supply chain disruption. And then the last issue we're really paying attention to is the high inflation being reported in many countries. And the prices are going up so much in a lot of areas that we do get a little concerned about consumer demand destruction. And with consumers having to pay more for food, energy, rent, healthcare, it's obviously taking away income that could be spent on cars, houses, durable goods, etc. So we're watching that quite closely.
Geopolitical risks?
The geopolitical risks, obviously the war in Ukraine looks like it may last longer than people originally expected. That's having a big impact on bulk type items, so coal, oil, grain, fertilizer. That's definitely rippling through various parts of the economy. And then China's zero tolerance COVID policy, while it's effective at limiting the spread of COVID and keeping people healthy, it does have a very significant economic impact, not just within China, but on global supply chains.
How are environmental, social, and governance factors, ESG, integrated into the process?
ESG is integrated into our investment process. We take a lot of data from MSCI and then analyze that and engage companies on various issues. It is important to have some background with the company and industry because sometimes the MSCI data can be a bit dated. They don't necessarily update things real time. And so we come up with our own DSM ESG rating that we apply to companies. Typically, we won't invest in a company if it has a score of 0 to 1. If it's in the middle area, like 4, 5, 6, as long as the companies are addressing the issues that cause the ESG numbers to be in that middle range, then we're okay holding those companies. But over the past 4 or 5 years, we have been engaging more with our companies on ESG issues.
Does DSM believe ESG can add value and or reduce risk?
It definitely can. I think it certainly can help reduce risk, especially on the reputational side. So if you are a retail company and it becomes known you're producing product with child labor or in very unhealthy situations, dangerous situations, consumers may not like that and may end up boycotting a product. It also can help identify potential shady practices by companies. And if they're doing one thing that doesn't sound too good, there are probably other areas of the business where that is happening as well. And those would be the type of companies you would want to avoid.
Eric, DSM has visited Australia many times, and so have you. What is it you like about Australia?
Well, the thing that first comes to mind, my colleagues would say the same thing. It's the people are incredibly friendly. It's just a pleasure to meet and greet and talk with people in Australia. Incredibly scenic country. The other thing that comes across, and colleagues have said this as well, is they feel safe in Australia. You don't have a lot of the violence, the guns, and things that you hear about in the States. And the last thing is, I just get a sense that people in Australia have a good work-life balance. So very, very impressed.
And how do Australian investors compare to those overseas?
That's a good question. I'd say investors in Australia are a bit more focused on our firm's culture and philosophy to help them understand how a DSM portfolio would fit into their overall asset mix. I'd also say versus, say, investors in the Nordics or Scandinavian countries, Australian investors are more focused on the fundamentals. And while they do care about ESG and certainly ask questions about it, I think it's a little less prominent than some of the European investors that we talk to.
What is DSM Capital's medium-term outlook for the asset class?
I'll just go back to our philosophy, and that is, if you pick quality companies with sustainable growth and you don't overpay for them, you will make money over time. So we've delivered good absolute and relative performance for clients over a long period of time by adhering to that strategy. Like I said, there may be short to medium periods where a stock doesn't work or trails the benchmark, but as long as the earnings continue to come in as we expect, over time, a stock price will reflect that earnings base and that earnings growth.
Thank you, Eric.
Thank you, Dennis.